Risk IV Beta and CAPM. We now have the market portfolio that is the most efficient. But even this portfolio still has a certain amount of risk. This risk is called non-diversifiable risk. A security's specific risk is the sum of its diversifiable risk and its non-diversifiable risk. Diversifiable risk can be eliminated by diversification. Non-diversible risk cannot be eliminated by diversification. Let's suppose investors are usually investing in a perfectly diversified portfolio. These investors assess the risk of individual stocks in relation to the market portfolio. When investing in the market portfolio, diversifiable risk equals 0. A security's non-diversifiable risk is the part of its standard deviation that correlates with the market portfolio. So, the non-diversifiable risk of particular security J is its correlation with the market times its standard deviation. The equation looks like this. In this explanation, please consider correlation J(M) to be a factor to reduce the risk of security J for the reason that it is part of the existing market portfolio. Security J's non-diversifiable risk is the amount of risk it contributes to the market portfolio. But how much does the market pay in expected return for taking on such risk? Let's go back to the capital market line. Needless to say, security J is in the market portfolio that exists on this line. The price for the market risk is the slope of the capital market line. The equation looks like this. It is the amount of expected return per unit of risk. Therefore, security J's risk premium, the amount above the riskless return, is its non-diversifiable risk times the slope of the capital market line. The mathematical expressions look like these. Please look over each formula. In the formula, this part is called beta. A stock's beta is a measure of its non-diversifiable market risk. The risk is expressed in comparison to market risk. Beta shows the tendency of a security's returns to respond to swings in the market. If the beta is exactly equal to 1, the security's price moves perfectly with the market. If the beta is less than 1, the security's price is less volatile than the market. If the beta is greater than 1, the security's price is more volatile than the market. Generally speaking, many utility stocks have a beta of less than 1. On the other hand, most NASDAQ-listed tech stocks have a beta of greater than 1, offering the possibility of a higher rate of return but posing more risk. Security J's total expected return, RJ, is the sum of the riskless return and risk premium. The equation looks like this. This model shows how much the expected return for a specific beta should be. If this price reflects all the information made available to market participants at any given time, the expected return equals the required return. So, in an equilibrium, the expected return is the same as the required return. The correctly calculated expected return for specific risk is nothing more than the required return. Therefore, it is this equation that gives us the answer to our original question: how should we assess an asset's required return? This equation prices stocks by specifying the expected return. When we use the more general concept that J is a capital asset rather than a specific stock, the above equation is called the capital asset pricing model, CAPM.